Dear students, today we are going to discuss a very important aspect in management accounting, that is preparation of cash flow statement. As per Accounting Standard 3, accounting standard preparation is mandatory for all the registered companies under the provisions of Companies Act 2013. Therefore, the cash flow statement is one of the important tool all the managers across the Indian diaspora needed to prepare. What is the very importance of a preparation of cash flow statement? It is very important to take a decision based on the rationale of availability of cash at the disposal of the manager. Therefore, it is very important to know what is the cash inflow and what is the cash outflow between the two balance sheet period. So, as far as our examination is concerned, in the examination they will give you the problem containing 2 years balance sheet in the same manner as you get in the fund flow statement. But how the cash flow statement is different from fund flow statement is the cash flow statement can be prepared in two methods. One is a direct method and another one is indirect method. Direct method preparation of cash flow statement is very much similar to the preparation of fund flow statement. Therefore, it is made mandatory by the accounting standard number 3 that all cash flow statements in India has to be prepared under indirect method. So in indirect method, first and the foremost thing what we have to do is that we have to understand the format of cash flow, preparation of cash flow statement. All the cashing activity are divided into 3 categories under indirect method. What are the 3 categories? One is cash from operating activities. The second is cash from investing activities. And the third is cash from financial activities. You may wonder, from the one balance sheet of 2 different periods, how you bifurcate all these 3 elements. It is very easy. We know that the cash from operating activity indicates that what is the cash in or outflow purely from the operating activities. Whereas investing activity talks about what is the cash inflow or outflow from the sale or purchase of assets and investments. And financial activity talks about what is the inflow or outflow from various financial resources. Now first we have to understand the format one by one. First, how to find out cash from operating activities. When the problem is given to you, the first and the foremost thing which we have to notify is that what is the profit and loss account balance which is given in the liability side of the balance sheet. The difference between the 2 years profit and loss account is the profit earned by the company during the year. That should be the profit, net profit before any extraordinary item. So that the difference amount you have to take as a net profit. If the difference amount is increased, say for example net profit first year 10,000, in second year 20,000, then the difference is 10,000. That 10,000 you have to take as a profit from before extraordinary items. And then to that, whatever the non-trading expenses or non-cash expenses, that item supposed to be added back to the net profit. non-cash expenditures such as depreciation, written off goodwill, preliminary expenses written off of discount on issue of shares and debentures. These items, along with the interim dividend paid during the year, these item has to be added back to the net profit of the year. And also we have to add the non-operating loss, such as the loss on sale of assets and investment has to also needed to be added back to the net profit. And also the proposed dividend of the current year and provision for taxation for the current year needed to be added back to the net profit. And if any non-operating incomes such as profit on sale of assets and investments and dividend received and interest received, if these items are there, these items should be deducted from the net profit, and whatever the result you get, that result is called as a net profit before change in working capital. Okay, this is the first step of calculating cash from operating activities. So the first part which we already calculated, which is net profit before change in working capital, to that we have to take current assets and current liabilities. If the current asset is increased between the two balance sheet, that should be deducted, put it in bracket. Bracket means cash outflow. Say for example, stock is increased from 1 lakh to 1,20,000. It means that we purchased stock to the extent of 20,000 during the year. Therefore, 20,000 cash outflow, we have to deduct it. And any increase in current asset should be deducted. Any decrease in current asset should be added back to the net profit before before change in working capital. But one thing we should remember is that when we talk about the current asset, this current asset does not include, it means you should not take the cash in hand and cash it back. Except that other current assets such as stock or inventory, bills receivable, debtor, outstanding income and prepaid expenses, the differences of the, I repeat again, if it is increased it has to be deducted, if it is decreased it has to be added back to the net profit before change in working capital. The same way we have to take the current liabilities such as creditors, bills payable, outstanding expenses and prepaid income. These items should be, if it is increased it has to be added, if it is decreased it has to be deducted. And one more thing which I have to note is that the bank overdraft should not be taken into consideration as a current liability. So then when you add up or deduct the current assets and current liability, you will get net profit before tax. From this net profit before tax, the previous year provision for taxation or tax paid during the year, which we know from the preparation of various ledger accounts. Because while preparing the cash flow statement, for the first and foremost thing what we have to supposed to do is that we have to prepare various ledger accounts to find out hidden informations which is not expressly given in the balance sheet. So for example, you have to prepare ledger accounts for equity share, preference share, debentures and general reserve, and also you have to prepare an account for all the fixed assets and investments, so that you can come to know that whether the purchase or sale of fixed assets or investments or issue or raising of any capital or loan or in such a manner if any redemption or repayment of loan or equity shares or preference shares, we will come to know by preparing the various ledger account. This ledger account gives us an idea whether tax paid is what is the amount of tax paid we have to deduct. So that if you deduct that tax paid during the year, the resulted amount you should call as a cash from operating activities. Then comes the second part, cash from investing activity. Is the very easiest thing, because cash from investing activity talks about a simple purchase or sale of fixed assets and investment. If any purchase happened during the year, then it has to be cash outflow. If any sale happened during the year, it has to be cash inflow, along with any interest received or dividend received during the year. So whatever the total amount you will get, that will be called as any cash from investing activity. And finally, cash from operating activity. Cash from operating activity merely states any payment of interim dividend or dividend paid during the year. This always results in cash outflow. And then the increase in equity or decrease in equity shares, increase in preference shares or decrease in preference shares, and share premium and debentures, redemption or raising of loan. This has to be in the cash from financial activity. So now the resulted amount you can call it as a cash from financial activity, and the total of cash from operating activity, cash from investing activity, and cash from financial activity together is called cash or cash equivalent at the end of the year. Here is the interesting part. Whatever the result you get as the cash or cash equivalent at the end of the year, to that, if you add opening cash or bank balance or bank overdraft, if it is there, it has to be deducted. If you add the opening balances of cash bank minus bank overdraft, you will get the closing cash or bank balance. If that closing balance, whatever you arrived with, will matches the figure which is given in the balance sheet, then you can easily say that your cash flow statement is accurate and you prepared it to the extent as per the provisions of Accounting Standard 3. So one thing what you are supposed to know is that the preparation of various ledger account is similar the manner in which you prepare it for the fund flow statement. There is no differentiation. But only the thing is that you have to follow the format by dividing the whole activities into three parts. What is cash from operating, cash from investing, and cash from financing activity. That is the major thing. So division is very important. But one thing you remember, for investing activity only fixed assets and investment will come. For financial activity only equity share, preference share, debentures and borrowings or loans will come. The rest, current assets and current liability, will come in the operating activities. So once you know these differentiations and bifurcations, it is easy for you to prepare the cash flow statement. Okay, I hope this will help you to an extent in preparation of cash flow statement. Thank you very much.